Today, once in a year, we basically talk about the trends, right? So every January we talk about this. This is my favorite presentation. It's also the hardest because I absolutely dislike taking data from a single source. So today you'll hear data from 4 very credible sources. Every time I tell you something that's a gut feel, I will come out and say it. I'll say it, this is me saying this, but the rest of the time at the bottom right of the screen, you will actually see the provider that's giving the information. So if it's CoStar, you'll see the CoStar logo. If it's Goldman Sachs, you'll see the Goldman Sachs logo. All right, so we've got a very action-packed presentation. I'm going to go very quickly, but I absolutely don't mind questions. So this is not one of those where you sit through the presentations and write down your questions for the end. Fire away, I'll answer as I go. All right, ready? Let's get started. All right, investment trend forecast for multifamily real estate in 2016. Actually, maybe I should have given it a different name because the first 5/8 of the presentation applies to all real estate. So it applies to single family, it applies to multifamily, it applies to medical buildings, it applies to storage, just about any sector, hotels. So the first 5/8 of the presentation is like that. So let's go look at those pieces. So I always start with a disclaimer. I'm required to do a disclaimer by my lawyer. So here it is. I'm going to read it out. I'll read it out very quickly. We're not investment advisors, and this webinar is provided for educational resources only. All investments involve different degrees of risk. You should be aware of your risk tolerance and financial situation at all time. Read all investment docs carefully before making any decisions. All information should be researched prior to investing any money. You're free to accept or reject all investment recommendations made by us. All services that we offer are subject to market risk and may result in loss to your investment. As you know, a recommendation is not a guarantee for successful performance of an investment, and we cannot guarantee against losses arising from market conditions. Bottom line, do not invest your money on our recommendation alone. Consult a professional advisor. All right, now that I've gotten through the legalese, and my lawyer's happy, here's our goal for today. Let's start with the state of the US and world economy. You cannot really talk about a projection of how real estate is going to do if you don't talk about the US economy, because real estate is really a reflection of both the US and the world economy. Then we're going to talk about the job market, right? So most people who are in real estate know that it's the job stupid, right? It's really the jobs that drive a particular market. So then we're going to talk about interest rates. This is a big one, right? A lot of people are going to ask about how interest rate is going to impact there we go. Let's see if that works. Yep. How interest rates are going to impact real estate. So let's talk about that biggie. And then after that, we're going to talk about another biggie that a lot of people in the Bay Area talk about, because we see Chinese investors coming in here and buying homes for cash, sometimes for over $1 million. So they're certainly impacting the Bay Area economy. I'm sorry, let me turn this off. Chicago. My team in Chicago is still working. So will foreign investors keep throwing money at the US market? That's a big question because they're throwing $30 billion at us, right? So that's the number in 2015. So it impacts the market. So we'll talk about that. And then the biggest one, in my opinion, of the major 5 factors, how are demographics affecting the real estate market? So we'll talk about it. Everything until this point, which is about 45 minutes from now, applies to anything in real estate. Hotel, storage, doesn't really matter. All of it is directly applicable. The next 3 portions of my presentation are specifically for people interested in multifamily. Multifamily supply. So once you get beyond the big 5 factors that affect everything in the economy, then you look at multifamily. And what's the single biggest thing that affects multifamily rents? It's incoming supply. And so many people in real estate completely ignore that fact, right? I love Houston. Houston is awesome. I can invest in Houston right now because Houston has a massive amount of supply coming through. And you'll see exactly how massive today, right? Doesn't change the fact that Houston doesn't have has a great future. It does. It has a tremendous future. But there is absolutely no doubt in my mind that rents are going to go down in Houston because the incoming supply, 30,000 units, is going to overwhelm the market for a year or two. Supply, key factor. Then we're going to talk about multifamily in 2016. What are the predictions from analysts? I'm going to give you my predictions, but I'm also going to give you the predictions from PricewaterhouseCoopers. I'm going to tell you who are all the different analysts and what are they saying about 2016. And then the last part, where's multifamily in the current cycle, right? So we talk about cycles, or some people talk about innings. I like to talk about baseball innings, right? So are we in 5th inning, 6th, 7th, 8th? The answer is every metro is in a different inning. And today, you're going to see every metro in the United States, and you're going to see what inning it's in. And then the end, some people are only here for this, so I'm reserving it for the end. The top metros for 2016, right? Some people are just here. There's this guy sitting in front of me that's predominantly interested in that, so I'm going to torture him for as long as I can. Top metros for 2016, according to the analysts and according to us. All right, ready to get started? Okay. So first, before we get started, where the heck is the data coming from, right? So the data came from somewhere. It isn't something that I dreamed up. Well, CoStar, right? That's one of the key providers. Billion-dollar apartment investment research and analytics company. The best money that a apartment syndicator could ever spend is a CoStar login. 1,500 researchers, full-time, just looking at apartment complexes. 200 Prius cars driving neighborhoods through the US. They also have a plane. And we've seen what the plane does. It actually maps, it basically gives you a top view of construction so they can find the buildings and then send their Priuses in. So a ton of the data you're going to look at today is from them. Then PricewaterhouseCoopers, right? Most people know them. When you go to the Oscars and they're handing the envelopes out, PricewaterhouseCoopers is the one that keeps the envelopes and makes sure that the awards never leak out. Big Five accounting firm, has a very large commercial real estate division. Goldman Sachs, my most notorious contributor, international investing banking firm that was largely responsible for the 2008 collapse, and then they made a lot of money off of it. So, watch The Big Short. So Integra Realty is a large independent real estate research firm. They're a competitor to CoStar. So 875 researchers, and they write beautiful research articles, right? So all four of these companies, their data is going to be shown to you today, and also a fifth one that nobody's ever heard of, but they happen to be experts in their specific area, which is foreign investment. So I have their white papers as well. So let's get started. The first part of my presentation, let's take a look at the US and the world big picture, right? So what's the big picture in the world right now? Well, first, let's start with the US economy, the local economy, right? So our economy actually continues to improve, and the all-important consumer confidence indices are actually showing tremendous improvement. You see all this stuff that's going on here? It's really nice. There's a tremendous upward trend. And you notice that in most cases before a recession, 6 months before consumer confidence tanks. So 2007 second half on that screen, whoops, right there. See that? So that's what happens. It's not happening right now. Consumer confidence is improving. Now, every time the stock market crashes, consumer confidence does drop for a month. But I've noticed that after a month, people realize that it's just a stock market. It's not the end of the world. And the stock market is not the US economy. It's just the stock market. All right, so what else? Leading economic indicators, also called LEI, and GDP are actually generally positive. So we've got good GDP growth, and the LEI indicators are positive. So if you look at the far right there, this area, very stable over the last year and a half. I don't see it going down at this point. And then let's look at what Goldman Sachs is saying about 2016. So monetary policy, and this is very important. I'm for a moment going to get geeky here on you, right? Monetary policy is what the Federal Reserve does. And the Federal Reserve does two things. They yank interest rates up and down, right? Or like all of the other banks in the world right now, they buy stuff by printing money out of thin air, also known as quantitative easing, QE, right? We've now had 4 rounds of this insanity called quantitative easing, right? So what's happening is the United States actually did QE very quickly in 2009. So we started the whole QE trend, and right there our economy turned. Now, there are a lot of bad things about quantitative easing, but one thing it's fantastically good at is it raises asset prices. It raises real estate prices, it raises stock market, and watch what happened. Now, Europe took its own time and didn't follow us, and as a result, notice that our economy has done really, really well since 2009, straight line upwards, and you notice that Japan and Europe, who are now doing quantitative easing, they're now keeping interest rates low, our path has diverged from them, because the United States actually has returned to health for the most part. So good for us, not so good for the rest of the world. So Goldman Sachs, regardless of the nonsense that's been going on in the stock market in January, does not believe that the situation is bad. I agree with them. The stock market tends to magnify problems in the economy, but keep in mind the Chinese economy, they have an incredible amount of money to throw at the problem. We don't. If what happened to the Chinese economy, what happened to their stock market were to happen here, we would be in trouble. They don't have any such problems. Firstly, they can do things by diktat. They can shut down their stock market for a week if they feel like it. The second thing is they have incredibly large US dollar reserves, and they can throw that at the problem. So they can recover. Now, all of that means still that the Chinese economy is not going to do as well in 2016 as it has been doing for the last 5 years. It's going to drop. Here, they're forecasting 6.5%. I think it might drop to 6%. But anybody that thinks that the Chinese economy is about to go into recession does not have any fundamental understanding of economics. That country still has incredible manufacturing prowess. They are not about to go into recession. They're about to suffer what they think is a recession. Their growth is going to drop, right? India is doing spectacularly well for one simple reason. Indians cannot afford high oil prices. When the price of oil drops to 30, India's otherwise magnificent economy comes to the fore. So for next year, India is predicted as the #1 economy, that #1 non-US economy. So they could have a growth rate as high as 7.5%, which is really good for India. So you notice a lot of economies, you notice the US right here, very good performance for us. 2.5% is what's predicted. I think that's a fabulous number for an economy that's already at 5% unemployment. So we think 2016 might not be a bad year. Now, that's right. So bottom line, US economy, good shape, good shape. We're doing really well. But an overzealous Fed, a hyper strong dollar, or a complete meltdown in China, very unlikely, or emerging markets, more likely, are the potential risks for 2016. So watch those markets when you're making your investment. Otherwise, looks like a solid year. I think if the economy stays on track for 2.25% growth, what does that mean? 2 million jobs, right? So forget about the 2.25%. Roughly 2.25% means 2 million jobs. 2 million jobs is phenomenal for real estate. All right, so that was number one. Number two, jobs. Let's look at the employment data, right? So the job market. So the first thing is there's some bad news here in the job market. So we keep hearing 5% unemployment. We keep hearing full employment. All of that stuff, and most people agree to it, is just nonsense because it's hiding the truth about the fact that the US labor participation rate is dropping and also that middle class jobs are disappearing. We call this the jobless recovery. Well, it's no longer jobless, right? People are getting lots of jobs. More than 2 million jobs were created just in 2015. So it's not really a jobless recovery anymore, but it's a recovery that seems to be one that doesn't have wage increases like they used to, right? So we don't think that the economy is really at full employment just yet. And here's a statistic that shows you why. You notice on one side, you see this constant increase in the number of jobs, but then on the other side, you see that blue line? That's the decrease in participation rate. What that means is less and less Americans are choosing to participate in the economy, so they don't get thrown into the statistics. So if I take 10 million people and remove them from my statistics and they're all unemployed, guess what? My statistics look really good, right? But they're fake. And most people know that, and that chart really shows you we're not really at 5% unemployment. We might be somewhere around 7 or 8. Now, are we a lot better than 3 years ago? Hell yeah, we are. So the news is not really all bad. The market is continuing to improve. And one of the big factors for that is because there's low inflation, the Fed has the time to allow the market to improve further to reach full employment. Normally what happens is when you get close to full employment, they start raising interest rates very aggressively because the economy tends to overheat. This happens 100% of the time. So they've got to raise interest rates. But this time inflation is so ridiculously low that they're taking it very slow, and I'm grateful for that. So you look at those two lines. Essentially what you need to know is that the country starts enjoying good times when the two lines come close together. Basically, the number of people looking and the number of jobs out there, when they get close to each other, those are good times. The good times are just beginning to start for the economy, right? We're just beginning to get to the point where people can demand more money. So you should start seeing some wage pressure in 2016. I'm going to actually go past this slide. Just want to point out that the big declines in 2015 in employment were really oil, was commodity prices, and mining. So for God's sake, stay away from any city that has mining. Stay away from any city that has oil or any kind of oil products. Even Houston, which is clearly the best amongst them. Stay away from all of them because for various reasons way beyond the scope of this presentation, the price of oil has become entirely unstable. And thanks to what happened yesterday, where Iran now has been allowed to pump oil again, a new 1 million barrels of oil will come into the world market, further destabilizing the price of oil. It could possibly drop to 20, which makes no sense because it actually takes more money to pull it out of the ground. But it could drop there for 6 months. Any city that's heavily dependent on oil, all kinds of strange stuff will happen there. Stay away from them. All right, so let's look at the job market last month, right? December 2015. I know people are listening to what's going on with the stock market, all kinds of bloodbath, blah, 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 blah. For a second, I would tell you, just tune it out. It's just the stock market. It likes to do these up and down things. And there are lots of very smart people that make lots of money when the market goes up and down, right? Volatility. One of my friends here is an expert at volatility. You want to talk about stock markets? There's a guy that you should talk with, Raman Bindlish. And what he's always told me is whenever the market's volatility increases, he has higher spread. Isn't that true, Raman? Right? There's a lot of people benefiting from this stuff that goes on, and the market is open to manipulation. Here's the true picture of what happened last month. We created 292,000 jobs after having already created almost 2 million in this year. So that's what's happening. The economy is really, really doing well, firing on a lot of cylinders. Is it doing great? Are the 90s going to come back, the late 90s? No, nothing like that. But this is really as good as it gets. When you get a 292,000 job month, after in October, that was 300,000. Pretty darn good. That's what's happening in the economy. So bottom line, adding jobs at a good clip, not at full employment yet. I agree with the guy, the Goldman Sachs guy, when he said that full employment will be reached at the end of 2016. What does that mean for real estate investors? You're going to see, unquestionably, at full employment, you're going to see wages going up. So if your properties have not been able to raise rents, they're in depressed areas, you will be able to raise rents. But the downside of that is the moment wage pressure increases, interest rate hikes will become faster. So properties, interest rates will go up at the end of 2016 and will start going up much faster because wage pressure, it immediately makes the Fed raise interest rates. All right, here's the next one. And I just want to say this up front. A lot of people in the Bay Area think that this is the biggest deal in the world. I don't. I know it's $30 billion. It's a lot of money, and they kind of throw it around all cash. So it messes with the Bay Area market. But the nation's market, I don't think this is as big of a deal. But I put it in here just because so many people talk about this. So foreigners plowed tens of billions of dollars into U.S. real estate. Will they keep coming, right? So this is what's happening. You see the picture on the right. Obviously, this is an upward trend. They're spending more. They're buying a higher percentage of real estate every year. And last year was pretty spectacular. 2015 was a little bit lower. 2014, they were just going insane, buying massive amounts of commercial real estate. So they've slowed down a little bit, but still in 15, the number is really, really high when you look at where it's been in the past. So let's talk about who Integra. Integra was researching this. Integra thinks they're very bullish. So they're saying there's no shortage of real estate investment options in international market, but foreign investors continue plowing money into U.S. real estate, a sign that international money regards the U.S. as a safe haven in global uncertainty. I very strongly believe this. Right now, there is a significant flight to quality. And despite what everybody else in the world thinks, the flight to quality takes money to the US dollar. It doesn't take money to the euro. It doesn't take money to the yen. It takes money to the US dollar. We're gaining against every major currency in the world because there's a flight to safety underway. So Integra thinks it's not going to stop. Integra actually, I didn't put the full article in here because it take you 10 minutes to read. They think it's going to accelerate if China continues having problems because Chinese investors will then consider the US to be an escape valve and will accelerate the amount of money that they're investing. I haven't seen that happen yet, but that's what Integra thinks.
I think just one point, I expect the Chinese government to put restrictions.
Absolutely. So that's a big X factor, right? The Chinese do these kinds of things. They can do stuff that other countries can't. So if that flow intensifies, which it might if their stock market doesn't get back up, they will put capital restrictions on there. And then the money will start to flow out through Hong Kong. They're also very good at getting around what their government does. So you should start seeing massive amount of purchases coming out of Hong Kong. That's really Chinese money. So we'll see how that goes. Now, there's a group called AFIRE, right? Their name is AFIRE. They're the Association of Foreign Investors in Real Estate. This is a group of 200 companies that buys $10 billion a year worth of stuff. So it's a good thing to listen to this association. They're very, very bullish on the US. This is the survey that they just completed of their folks. The US is doing better than last year. They're predicting a better year from their investors. And all of their investors are massive in size. So these are people buying one building for $500 million. That's the sort of members that this company has. So look at where the US is for 2016 compared to 2015, and also compared to the rest of the world.
Yeah, quick question.
Yeah.
Does that include single family homes?
So the fact is, AFIRE's members tend to mostly buy commercial, but the answer is it does, but it's not truly representative of the big single family market. It's mostly representative of the commercial market. So here's another one. Expected changes in cap rates. So the AFIRE members are actually expecting that for multifamily, the rates are going to either not change, which is white, or go slightly higher, or go much higher. So when they're expecting to do that, and they're trying to spend more money, what does that mean? They know that cap rates are going to go down, right? So they're going to be lower cap rates. I'm sorry, I lost my chain of thought there. Oops. Let's get that back. Wake up, wake up.
The loss continues.
That's right. No signal, no signal. What just happened here? Did we unplug something here? Let's look at this. There we go. I think that should come back. Yeah, it was Holly. Hang on. Okay. So let me go back here. I'll come back to that. The point there was, we don't think that there is a lack of real estate investment for 2016. We think that this is a market that we need to watch, but it seems like they still love America. It seems that foreign investors love us, and they will continue to give us money, and it's going to continue to buff up our real estate market. There really isn't any sign that they're going to move away from the United States just because our real estate is more expensive than it was last year. Okay, interest rates. So the other one that tends to have a lot of discussions, people talking about interest rates and the role of the Fed and how that's going to affect real estate. Let's talk about this. So does anybody know, are interest rates now higher than they were on December 16th when the Fed raised rates? Higher? No. Interest rates today are actually lower. Most people don't understand the Federal Reserve does not control mortgage rates in the United States. All the Federal Reserve does is they control what is known as the interbank rate, the rates at which banks lend to each other. Now, very often, almost 50% of the time, the mortgage rate and the interbank rate actually don't do the same thing. So if you look at the graph on the right, the first dot is the day that the Fed raised rates. The second dot is this morning. Today in the morning, you look at Jan 14th there, the rate is lower. So they raised the rate by 1/4%, but the actual rate at which you can get money right now has gone down by 1/8%, right? So bottom line is this: there are a very large number of factors that affect mortgage rates. And the federal policy is only one of those factors, and in some cases, in certain situations, it's not the most important factor. So here are why interest rates are not going up at this point in time. Number one, we have a ridiculously low inflation. Does anybody know what inflation was in November or December? Year-over-year inflation? 0.5%. And I know it's a little bit rigged because they take food out and they take other stuff out, but right now, gas is cheap too. When gas is cheap, food is cheap, right? Because to get food from 2,000 miles away from a farm to here, you need a lot of gas. So right now, inflation, both core and CPI, are really, really low. We're at 0.5%, this low, right here. It hasn't been this low unless it was in a recession. So at this point in time, in an election year, how can the Federal Reserve raise rates when there is no inflation? Isn't inflation the #1 reason to raise rates? Here's another reason why interest rates are not going up. Does anybody in this room know what the velocity of money, or M2, is? So money, a dollar, rotates around the economy and then comes back more or less to the same people, right? So if I buy something from a factory, right, the retailer gives that money to the factory owner, and then that retailer then sells it to Target, and then Target sells it to a person. That person basically eventually, gives money back over. So the money at some point will come back to the retailer, right? It's a circle throughout the economy. And M2 is something that studies how often does the same dollar rotate throughout the economy. M2 right now is the lowest it's ever been. No one understands why. Most people are afraid of why it's decelerating. And M2 right now is down there. And this is the scary part of our economy, because there isn't an economist in the world right now that understands why M2 is so low. It shouldn't be this low. It should never, ever, in a normal economy, the velocity of money should never be this low. So I might spend a day talking about why it could potentially be low, but nobody knows. But here's what this means for real estate investors. We are facing deflation, not inflation. When you are in a deflationary environment, the last thing that the Federal Reserve should be doing is raising interest rates, okay? Because dropping interest rates will create some inflation. And what is worse, inflation or deflation? Deflation, because the inflation can be controlled by the interest rates. Guess what happens when you get deflation? There is no control. You just wait for it to burn through, and it might take a year or it might take a decade, right? What's an example of an economy that is now half the size of what it used to be in the 80s because it went into deflation and never came out? Japan, there you go. Half the size. One of the greatest economies in the world is now half its size. It went into deflation, never came out. The Federal Reserve will never allow the United States to go into deflation, because at that point they lose control. And when the velocity of money is so slow, it really doesn't make sense to raise interest rates too much. Now, that quarter-point raise, it was there because they had been talking about it for 2.5 damn years. They had to do something, but I think it's one and done.
What can the government, what can the Fed do to stop deflation? They can reduce the 0.25%.
No, that's not true. So Europe now has negative interest rates. There is absolutely no law in the world that says interest rates have to stop at 0. You can have an interest rate minus 3%. Effectively, there are 2 or 3 countries in Europe that are right now charging money to people to put money in banks, and people still do it. I'm not sure why, but they still do it. So Google negative interest rates, and you'll see what countries they are in Europe right now are charging. Switzerland, thank you. Switzerland is negative at this point in time. So there's nothing to prevent the Fed from having a negative interest rate. And it will happen if we go into deflation.
They're pretty happy with it. Like they're saying the economy is improving.
Yeah, it's fine. That's right. By the way, where's Bill Neville? Bill Neville in the room somewhere? All right. So this guy, Bill Neville, right? He works for Entrust, which is an IRA company. I implore you, if you look at the stock market performance for the last 15 years, right? There's calculators on the web. Start on Jan 1st, 2000 and go to all the way to the end of 2015. Or if you really want to feel sad, go to the end, go to today, right? And look at the annualized performance after inflation. It's very important to look at it after inflation. After you look at that, I think you would really want to move your 401k to what he does. What he does is self-directed IRA. I worked here for 17 years. Can you imagine how big my IRA would have got, my 401k would have gotten? I was chief operations officer of this place, 350 employees. Every dollar that I have is in IRA. Every dollar of that is in multifamily somewhere. And lots of people invested in me. I'm co-invested with him, for example. Love it because I'm getting positive growth on my money. So talk with Bill at Entrust. Very good decision. They've got phenomenal rates, which are a fraction of the gouging that is going on in the 401k market. And I'm gonna get off of that. I'll be going there for an hour. All right. So the last piece of it, why are interest rates not going up? The US dollar. Have you seen how it's strengthening against every major currency in the world? So and this trend is going to continue. It seems that the euro will reach parity with the dollar sometime next year. Guess what happens? Inflation reduces further because Americans can use the same dollar to buy more stuff. And oil is at 20 plus dollars, and oil is priced in dollars. So what is very likely is that the US dollar will further strengthen, reducing inflation further. So bottom line is this. I'll say this for the record because I don't want somebody to kick me later. We think the Fed will raise interest rates twice in 2016. They might go once, they might go twice. I still think they will go one more time, but probably second time in the second half of the year. They also might go twice. However, I don't think this is going to raise mortgage rates by 0.5%. Because of the velocity of money slowing, mortgage rates are not obeying interest rate rules. They didn't do so in the last month, and I don't think they're going to do so in 2016. So I think we're looking at 0.2 to 0.3% growth, but please heed the warning at the bottom. I believe that the economy will reach full employment at the end of 2016, so high rates, much faster interest rates will come in 2017. So lock in 2016. Isosa? Yeah? Lock it in. All right, so that was interest rates. Now here's my favorite portion of the presentation, the one I think is the big one. I don't think it's interest rates. I don't think it's foreign investment. The economy is important and jobs are important, but to be honest, the US is doing really well on both counts. Here's the big one. This is the one that I think drives real estate growth and has driven it for the last 5 years. Demographics, millennials, boomers, echo boomers, all these groups of people, what are they up to? And how does it impact real estate? So here's the biggest trend, and I think most of you know this. Younger age groups are not able to save money at the same speed as before. So you've got them having trouble for a down payment, right? Because their incomes are moving up very slowly compared to pre-recession times. So here's a graph. It's really complex. So I want you to completely ignore the bars. I don't know why they did it this way. Ignore the bars and just look at the triangles and the little dashes. The dashes are hard to see, but they're here, 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 there. You see the blue dashes? So each triangle was the income increase in every year for that age group. So 15 to 24 years. Sorry, there's people in the other room. 15 to 24 years. Let me get my highlighter back. So you've got to compare this versus this. So before the recession, this particular group had a 4% increase in their income every year. Now it's 2. This group, 3, 2, 2, 4. You notice a trend. Younger groups, their incomes are not growing fast enough, so they're not able to save for homes. I know in the Bay Area, everybody thinks that there's no homes. That's just a short-term supply issue. The Bay Area has a supply issue, which is really bad in San Francisco. In other places also, there's Chinese money coming in. But when you look at the United States, what we are seeing is a consistent slowdown in the real estate market, right? And a lot of this is because of these first 3 bars. Their incomes are not growing quickly. Homes are getting more expensive, so they're not saving. So what is the impact that this is having on single-family purchases, right? So here's the impact. Roughly 17% of millennials owned homes as of 2005. You see that peak there, right? Right there, that peak. Now that number has dropped. It's at 13%. And I get, when I teach multifamily fundamentals, I get challenged a lot on this number, saying, oh no, in 2015 things changed, right? Millennials spent more money. Oh yeah? Take a look at this. This is home ownership as of the end of September this year. It's now down, and this is nationwide. This is not just millennials, right? The impact that the millennials are having is so massive that this number is down from 64.4 to 63.7. You might say that's 0.7. Yes, 0.7 is 700,000 homes that have gone down in demand in 1 year. Do you know what that does to the real estate market? 700,000 homes, right? That's what's happening in the single family market. What does that mean for multifamily? Well, obviously it means a lot more multifamily. Over 6 million multifamilies demand has been created just in the last 8 years. Take a look at this. You see this portion here? People less than 35 years have created over 1.5 million multifamily households. 1.5 million, 2 million, 1.5 million. That's an astonishing number of new multifamily units in 8 years, somewhere around 6 or 7 million. Does anybody know how many new multifamilies we build every year? Guess? We build 300,000. How much new demand have we created in the last 8 years? 6 million. More than 6 million. So you see this massive demographic trend, this shift, right? That's what's driving the insane rent growth in the multifamily market. Last year was 6% nationwide. In 10 years ago, if you told people you'd get 6 years of growth in the whole country, people would think that you were insane. But it happened last year. So that 6 million is renter household growth. Take a look at this, renter household growth. It could be either. So it could be, they could be living in single families as tenants as well. That's right. But if you're a multifamily guy, that's still your market, right? Because they move back and forth between single family homes and multifamilies all the time. Question?
Did I hear you right that it's surprising that there were 6 straight years of rent growth? That's unusual?
No, it's the amount of rent growth that's unusual. Normally, the US, the average is 2% rent growth annually, right? So that's our long-term average. We haven't been anywhere close to that average for the last 4 years, not even close. So
Rent growth in a low inflation environment is surprising because usually it matches with inflation.
that's right. If there's high inflation, like in the 80s, you had rent growth of over 10% a year because interest rates were at 18%. So right now, that's a very, very good point. You've got inflation at 0.5%, and we just went through, I don't think it was quite 6, but 5.5% of annualized rent growth. And it wasn't even. The coasts were crazy. Oakland was the largest example for the year at 22%, right? So they had by far the largest increase in the US. So it was not even across the United States.
So the 6% rent growth, is that indicative of the average rent growth across major metros in the US?
The entire country. So and again, it was about 5.5%, but the entire country had 5.5%. But keep in mind, the coasts had way more. So Denver, Seattle, and the coasts were way, way, way more than most metros. Yeah.
Just a suggestion for the sake of the other room, you may want to repeat the gist of the question before you respond.
Makes sense. Thank you. Thanks for reminding me. Yeah. I tend to do that even when I'm teaching online. All right, so this change is driving long-term demand, and those folks that have seen multifamily fundamentals have seen this. Only half of renters have now said they anticipated becoming homeowners in the next 5 years. This number has never been this high. In the past, most people said, oh, I'm only going to rent for a couple of years, then I'm buying a home. Most people said that. Now, 50% are saying it. Renters are also more committed to living where they have been. So now they want to live where they're living longer. They don't want to buy homes. And most importantly, they're liking the freedom of the renting lifestyle because they want the good schools, the safe neighborhoods, the parks, the community centers, and the neighborhoods. Those are all the things that they're looking for, and they're getting priced out of those when they're buying. So that's what they're looking for. They're liking the freedom of the renting lifestyle. So how does this impact single family and multifamily starts, right? The number of new units that have broken ground. Take a look. Multifamily permits jumped 29% from 24 to 2015. What about single family? Anemic, 6.7%. How can it possibly be this low when we didn't build single family homes in this country in 2008, 9, 10, and some part of 11? We didn't build any, so our stock should have been really low. We are currently at 53% of where we were at the peak in 2006. So why is there only 6% growth? Well, that's because all the growth is really going into this other number. The growth has moved from here to here. It's going in that direction. 29% is the growth in multifamily. It's spectacular. But guess what? What's this number? Look at this number. I think this is the most important number I'm going to show you today, right? So there's 300,000 starts in multifamilies. That's how many units we're bringing online, right? But how much demand did we create? 6 million in the last 8 years, right? Isn't that an annualized demand of 700,000 or 800,000 units? How many are we building? 300,000. And guess what? Here's the biggest problem, and most people don't see this. This is why class ABC is very important when you start learning about multifamily. All of the 296,000 are class what? A, right? And all of them are being sold, rented at prices way above what the common man wants. The Class C and even some Bs cannot afford all the As that are being built. Now, does anybody have an idea of what has happened to Class B and Class C inventory in the United States in the last 10 years? It's declined. It has declined. As a result, vacancy numbers in Class B and C have declined. What has happened to vacancy number in Class A in the last 2 years? It's gone up. Their vacancy numbers are going up. B and C, our vacancy is going down because nobody's building any Bs and Cs, right? Because you can't afford to build them. In Chicago, we just bought a Class C at $50,000. In the Loop, they're building Class A's at $250,000 because that's what it costs to build it.
500.
Yeah, well, they're selling at 500. So the people are paying $500,000, but it's costing the developer $250,000 to build it. How in God's name are we going to resolve this problem where we have more poor people in the country now and we have no B and C inventory? This country used to have an incredible affordable housing program. We would produce 250,000 affordable housing units. How many did we produce last year? 17,000. Basically, what happened was the Bush administration cut 90% of the funding for affordable housing in 2001. It never came back. Obama never had the money.
Get another Republican in there.
That's right. Yeah, let's do that. That's going to really help us. That's right.
Yeah.
I was being sarcastic.
Yeah, you're going to get beaten up in the parking lot today. All right, so now let's take a look at some opinions. So analysts, what do they say about demographic tailwinds? Here's PricewaterhouseCoopers. So this is their highlight, not mine. This is the end of their report for the year. Demographic tailwind for rental apartments and continued urbanization is a longer-term trend that will make multifamily a good sector for a long time. That's what they're saying in their most recent report. It came out a week ago. Now, keep in mind, you might be wondering, where the hell do I get all this data? So the answer is, I'm not supposed to have access. I don't pay for PricewaterhouseCoopers, but the web is one of these nice places where people who do pay for it might put it there, and then somebody like you might Google it, you know, Pricewaterhouse 2016 real estate trend report, write that down. And you might find something really interesting, just like I do. So it's really a report for their customers, but the web is a very leaky place. All right, so bottom line on demographics. I think most people think that what's keeping the party going for multifamily is not the low interest rates. It's this colossal 6 million person demographic shift. And we're going to talk about how long the party can keep going in the next couple of chapters, next couple of pieces. All right, so everything I just said applies to everything in real estate, right? Whether you're looking at storage units, whether you're looking at medical office. By the way, storage units and medical offices are two large thumbs up in that same report that I just talked about. I'm here for multifamily, so I wouldn't talk about it. But if you're interested in other sectors, they are in the same report. So now let's get to multifamily, right? And multifamily, what's the biggest thing that impacts it again? What's the biggest thing? Supply, right? It's supply. What's coming into a market? How's that going to affect rent and vacancy? Well, here's some bad news. You see all those bars, positive bars? They're increases in vacancy. Is increase in vacancy good for multifamily? No, it's a bad thing, right? You don't want vacancies to go up. Now, these are not massive numbers. So if you look at the if you look at the left, this is not a 50% increase in vacancy. It is a 0.5% increase. 50 bips is 0.5%. You notice out of the 50 major metros in the United States, there are only 3 that are actually going to see vacancy declines. All others, 47 of them, will actually see a vacancy increase. Why? Supply. The supply is finally coming in. We said it would come in 13. We said it would come in 14. We said it would come in 15. It's now here, right? So supply is hitting all US metros with the exception of these 3. Now, that circle on the right, are those good places to invest in 2016? No. For God's sake, stay away. 1% increase in vacancy equates to how much of a decrease in rent? Guess? Between 5 and 10%. So if you are going to make 10% on a multifamily, you will now make 0. right? Do not go into those markets on the right. Feel free to take pictures, that's fine. By the way, anything that says CoStar, you'll never get to see again. Chicago's always in the middle. In every slide that I'm going to present today, Chicago's always in the middle. There. So I paid $32,000. I'm not supposed to show you these, but I do it once in a year. So you will not see those on the web. So anything on the right, don't go there. Now, here's a question, trivia question. What about these three? Should we invest in these three? Yes?
No.
Just because they're vacancy? Okay, so the answer is not yes, it's not no. The answer is maybe. Okay, so let me give you two scenarios. Scenario number one, that metro's vacancy is decreasing because no builder ever wants to build there, right? Because the wage growth is so low that whatever they build is not going to rent. So there's going to be some decrease in vacancy, but you don't really want to go in there. It's got low wages. Here's the other scenario in which vacancy decreases. What if nobody is building because population is declining? Would you ever want to go into a metro that has a population decline? Absolutely not. Absolutely. If you're buying at 20 cents on the dollar, still don't do it. Do never go into a metro with a population decline. It is the absolute worst thing to do in real estate. So, yeah, notice Detroit is up here, right? The answer is Detroit is an interesting example. This is a city that has seen population declines for 50 plus years, almost irreversible. They've tried for half a century. They did temporarily reverse them this year. In my opinion, it's better for you to go to Las Vegas and spend your money there than to go to Detroit, because just because they reversed that trend for 1 year, and that's a very small vacancy increase, I don't think it's going to happen again, right? So there's a lot of people there that are betting that their bankruptcy is going to resolve all of their problems. I think it's one of the most corrupt cities in America, and a bankruptcy is going to resolve nothing. Yeah.
Are these vacancies mostly going to be in the Class A new construction that you talked about?
Very, very good question. Wait 2 slides. All right, so here's where the inventory growth is coming in. Dallas. So one very important thing is, by default, a growth in inventory does not mean that that metro is going to do badly. In my opinion, Dallas is going to be Silicon Valley 20-25 years from now. That place has astonishing growth in front of it. That doesn't change my mind on maybe Dallas is a little overpriced right now. It might be, right? That doesn't change my mind on how it's going to do over the next 10 years. Dallas needed 35,000 units. It's Houston that's going to have a lot of problems, because Houston didn't need 30,000 units, right? Dallas, I think, is going to do just fine next year. So keep in mind that just larger number of units doesn't mean that that area is going to have a decline. You also have to look at how much demand there is. In Dallas, I think the demand is in excess of 35,000 units. Compared to what? So cap rates in Dallas are not depressed compared to the San Francisco Bay Area. If it starts to exhibit the same characteristics that the Bay Area does, they're still incredibly cheap. People are still buying at $50,000 a unit. Try and buy anything. You can't buy a garage here for $50,000 a unit.
I don't consider it fair.
It will. I think it will eventually get there.
What about Austin? Because Austin has seen a lot of job growth.
So Austin's here, right? And the one that you should look at is the previous one for Austin. So do you see Austin? I know this is all squeezed in. Where's Austin? Okay, so the answer is Austin is overbuilding. It's overbuilding. Be careful, right? So this combined with the other one is important, because Dallas is not up there on the right, even though it's building 35,000 units, because it has a lot of demand. It'll get absorbed. So here's what happened in the last 2 years. This is about to answer the question that my friend here asked, right? Notice what is happening. You see 2 colors of arrows. You see blue arrows and you see orange arrows, right? The orange arrows are where we live. John Mark and I live in class B minus C plus areas. Most of our complexes like that. We'll buy Bs, but these days they're harder to find. So we mostly buy B minuses, C pluses. That's orange. Notice what's happening. The arrows are mostly reversed, right? What does that mean? the A-class units, vacancy is increasing. Blue arrows moving to the right. The C-class, the vacancy is decreasing. Orange arrows moving the other way, right? And this is, again, that whole concept of they're building 300,000, but everything's Class A, right? So what's happening is Class A increases in vacancy are decreasing Class B and Class C vacancy. It's a very odd phenomenon. We haven't seen it before in the US, but it's happening, and it has been happening for the last 2 years. This is where you should be investing, the oranges.
Orange is what? C plus and B minus?
B minus is, well, C plus is, yeah, in that range, right? So CoStar doesn't call them that. The property we just purchased, it obviously is on CoStar's website, and it's ranked a 3-star. So we're a 3-star, but 2s and 3s are kind of clubbed together, and 4s and 5s are clubbed together. So a B plus all the way to an A is like a 4 or a 5-star. All right, so here we look at how many units there are, multifamily starts and permits. We look at, let's see, we're roughly at 150,000 units. Now keep in mind this is mostly Class A and B. People are still building lots of triplexes, quadplexes. So the total number is about 300,000, but it's not massively in excess. A lot of people say there's a bubble in multifamily. If there's a bubble, why is the long-term red line so close to the 2015 number? Where's the bubble? How can you have a bubble when you're slightly over long-term mean? There is no bubble. All right, so now time for predictions. Predictions from us, predictions from the people that we've been talking about today, PricewaterhouseCoopers, IRR, and CoStar. Number one, the prediction from IRR, which is Integra, is outstanding performance in 2015 simulates confidence for 2016. And what they're saying, I think, is true. It's difficult not to be bullish on the sector heading into 2016. Strong hiring numbers, strong US economy, vacancy rates are at 14-year lows. Now, that's not necessarily a good thing because they'll go up a bit, right? But vacancy rates going up half a bip is not going to change a sector from wildly bullish to bearish. It just doesn't happen. It needs to go up 2 or 3% for that to happen, right? So what we're going to see is steady demand growth, and we're mostly going to see maintenance of vacancy levels, just a little bit of an increase. Now keep in mind that increase is expected mostly to come in Class A. Now in a couple slides we'll show you what will happen to Class B and Class C. And here's another thing from Integra. Provided employment gains continue, the multifamily market will enjoy continued interest due to pent-up demand, current buy versus rent preferences. Remember, that's again the millennials, they don't want to buy, right? And the need to replace aging post-World War II inventory. There's a lot of it. There's over, I think, somewhere around 5 million units that need to go, and somebody needs to replace them. Prediction number 2, I think. This is PricewaterhouseCoopers. I showed you this before, but I'm saying it again because this is what PricewaterhouseCoopers believes. Demographic tailwind. That's why I've said the big one is demographic. Stop worrying about interest rates and stop worrying about what foreign investors are going to do. Look at that 6 million person tailwind. Cap rates. So cap rates are expected to stabilize. We do not foresee cap rates to continue declining. They declined throughout 2015. We think that they're stopping. We think that, and this graph is a quarter old, they stopped in Q4. So Q4 was the first time in 12 quarters that multifamily sales actually declined a little bit, which is normal. If they keep going on a tear and they're higher and higher and higher every quarter, at some point it's going to happen. Even Apple every once in a while has a bad quarter with the iPhone, then everybody thinks gloom and doom, and then they crush it again, right? So at this point, we think cap rates are stable in 2016, at least in 75% of the markets. They're going to go up in a few and come down in a few, or you're going to see those markets in the next section. Rent growth. Here is the really good news. 2016 is unquestionably going to be an above average year for rent growth. This good. Look at the numbers. They are spectacular. And this is from CoStar. Spectacular. We're expecting somewhere between 4% and 6% rent growth annualized for 2016. Now keep in mind, the It's possible that the Class A's will get a bigger share of that and the Class C's will get a smaller share. Hard to tell. Here's prediction number 4, my favorite, right? Because I don't like Class A much. Which multifamily class will outperform? Here's what CoStar says. Over the last 2 years, something amazing has happened. These bars are showing you what happened in the last 2 years, the change in vacancy. This is Class A. Look at what happened to their vacancy. It actually increased by 1%. At the same time as Class A vacancy was going up, Class C vacancy was going down. Now this is, 1 star is more like a very war zone type of places, so we don't, want to talk about them. But this is mostly where most of us should live. Please don't go here. You could get shot just entering one of your properties. So this is safer. Go here. 3-star properties. And you notice what has happened. Their vacancy has gone down. Conventional wisdom in the United States is if Class A vacancy increases, Class B and C vacancy will increase after 18 months. Why? Because Class A people, when their vacancy increase, what happens? They drop prices. When they drop prices, some of the B people move up. Then the Bs drop their prices so that some of the Cs move to them. Yes, that's conventional wisdom. Is it happening? It's not, because nobody has built Bs and Cs for 15 years, right? Since affordable housing stopped, nobody's built it. So we have this incredible advantage right now, if we live here, that we're still seeing vacancy declines where the US is forecast to see vacancy increases. Spectacular. Not me, CoStar. PricewaterhouseCoopers. You might want to read this whole thing. It's very interesting, right? So some adopt the Baseball Hall of Famer Willie Keeler's advice. Keep your eye on the ball and hit them where they ain't, right? A West Coast investment manager reported an investment program on Florida's Gulf Coast that Isosa and I might know a little bit about, still rebounding from the subprime mortgage crisis, where good quality apartment complexes have been acquired at 7.5 cap rates, prices in the $50,000 to $75,000 per unit range. Yes, somewhere in there. Yes. So with many echoing the financier who told us values in New York and San Francisco are just ridiculous, we see a trend in finding multifamily housing opportunities where costs are more manageable, looking more favorably at the garden apartment subsector. So if you don't understand what garden apartments are, find out. Essentially, one rule of gardens is they tend not to be over 3 floors because they rarely have elevators, especially on the Cs. The Bs have elevators even if they're 3 floors. The Cs don't. So they tend not to make them over 3 floors. Not a hard and fast rule, but in most cases they tend to be that size. Ooh, did I do something?
You did.
Oops.
You fixed it.
Oh, there you go. Okay. Does that make sense? Right? This is what PricewaterhouseCoopers is saying. Look at the garden units. It's now time to look at the garden units because the core cities are getting overpriced. Prediction 5. So this one's a very heavy one. So I'll go through it quickly because we've sort of covered it. Supply, demand, and vacancy. The red bar is showing, it's kind of hard to see. The red bar goes down. Vacancy has been extremely low. Oops, let me go back and get this thing here again. No, it doesn't want to do it. On the right, the vacancy has increased just a little bit. It's still very, very low compared to the norm. You see that bar going across the page? That's where the norm is. So obviously vacancy for multifamily right now, A, B, C, it's spectacularly low. You are going to see a little bit of a vacancy increase. Remember my chart about 50 cities where almost all of them had slight vacancy increases? So there's going to be an increase there, but overall, because demand and supply are so close to each other, it's not going to make much of a difference for 2016. So those are all our predictions. So bottom line, growth will moderate, cap rates will go down. Well, I'm sorry, I actually wrote this and then came back and looked at what they were saying. Cap rates will stabilize, they will not go down. Rent growth will be strong. New supply is being considered by analysts as a bigger factor than interest rates. So look at the supply going into your market. A lot of people simply don't Google supply, new multifamily stock in X, where X is your city. I know there are people in this room looking in Sacramento. Have you looked at how much stock is coming into the Sacramento market in the next 12 months? Why in God's name would you buy a 5-year project without looking at that stock, right? It impacts everything, and it does it in good cities and bad.
Even if you're going for a Class C property?
The answer is you've got to look at what the delta is in that market between a Class C and a Class A price. So in San Francisco, you couldn't care because the delta is huge. In other places, because it might be $2,000 delta. In other places where the delta is $400 or $500, it's going to impact you. It's going to impact you. So we get the SOSA's part, right? So where is each market in the current cycle, plus best cities to invest in and cities to stay away from? Ready? Cameras ready? All right. So before I do that, I want to give you an important distinction. Most people in the room will not like this. The magic of real estate is in the sub-market. It's not in the major market. What I'm about to tell you will help, but don't just show up in Atlanta or show up in Dallas and say, I will buy something here. No, look at each sub-market because they vary tremendously. One sub-market can grow at 3 times the speed of the sub-market next to it, right? So know your sub-market, but it really helps to know the metros first. So you still want to know, right? Mm-hmm. All right, here's our take. First, CoStar. Now this is going to take a little bit of time to read. CoStar does this grid, and I haven't shown you the bottom because there are no cities in the bottom 2 grids right now. Wow, look at this. All right, occupancy going up, rent going down, occupancy going up, rent going up. This is magic, right? You love this quadrant. Here, occupancy is going down, rents are going up, right? So you don't like this quadrant as much, but rents are still going up, right? But at some point, what will happen is the cities here will pass through and go to occupancies going down and rents going down. This is a cycle. Notice the city closest. Houston. Why? Massive hypersupply, right? 30,000 units built in a single year and delivered in a single year. Here, less supply, but also a lot less demand. So this city has had rent increases and is going in that direction. Some cities need a lot less to go into this curve. So keep in mind that these cities here are dangerous. Raleigh has very heavy supply as well. So be careful here in this area. Now, you might say, Chicago is here. Why are you investing in it, Neal? Firstly, when we bought, we invested at this price. We bought at that price. The other thing is, we are not in one of Chicago's hot submarkets. We did not see a 6% rent increase last year, and we are not going to see a 6% increase in vacancy this year. So we didn't see the very good there, and we didn't see the very bad. We are in a suburban market where rent increases were 3%, not 6. Chicago had a 5.7% rent increase, but also all of the inventory, 100% of the inventory in Chicago that's new, that's coming in, is all of it goes into a place called the Chicago Loop. Chicago is not building everywhere. They're building in one place. So I don't have to worry about it because they're building at $250,000 a unit. We purchased at $51,000 a unit, right? My tenants cannot afford to pay 5 times as much rent. Does that make sense? But it's very important for you to look at this graph. Obviously, it's better to buy somewhere here. Sometimes buying here is also problematic. Some of these you won't be able to buy in simply because the cap rates are too low. Right here, most of Los Angeles does not cash flow. So it might be a very good market. And you say, why do they put in this quadrant? The answer is, it's a great market for pension funds. So there are some markets in the US that are considered first-class markets. They don't decline easily. They are very risk-averse markets. They have great fundamentals. The San Francisco Bay Area and Los Angeles, Denver are markets that don't decline easily. Denver has recently, in the last 5 years, become one of the top markets in the US. So if I'm a pension fund and in the stock market I'm returning minus 5%, I'll take 7% in Los Angeles. I don't want to take any risk. It's a great market for them. Now, there's Detroit in here as well, but as I said, you should hope that it continues not to lose people, because otherwise it's going to go right from here. Do not pass go, do not collect 200, straight down here, right? So be very careful with Detroit. Huntsville is not a metro, so it wouldn't show up here. In my opinion, Huntsville, Alabama is doing really well, and you should look for something there.
Charlotte was on a list on the far right on one of the slides where it was too many buildings going in.
Right.
And over here it's on the top of the
2 different providers. So I think one of the ways to look at this is hopefully you take a picture of all 3 slides and pick the common ones. I don't know. Somebody paid off their analyst? I'm not so sure. So there's usually reasons, right? So the market might have very, very strong fundamentals, but might have 1 year of hypersupply. So it's going to bip up in vacancy, but they still consider it to be a great market. I'm not saying that's the case, but it could be. In general, by the way, North Carolina, South Carolina have really good cities, except for Raleigh, which has overbuilding going on. South Carolina is really good. So I'm going to show you the ones that I'm invested in on this graph. Apart from the Bay Area and Chicago, there isn't anything. But the next one that's coming up is there. By the way,
East Bay, is that in here? Oakland?
East Bay is here. Yes. Yeah, that's our East Bay.
I have a question. Doesn't the chart says that we should not invest in most, because everything is in almost right? Shouldn't, like, it's not a good time to invest because we are late in the cycle anyway?
The answer is no. This is not considered late in cycle. There's plenty of money here. This is late in cycle. So the answer is there's plenty of money. There's cash flowing properties. You're definitely better off investing here than you are investing here, for sure, right? Keep in mind that this is also a risk reward spectrum. This is higher risk and higher reward. This here is medium risk and lower reward.
Why is the left higher risk?
Because those markets have just started recovering, and the recovery may stop easily, right? Northern New Jersey is one of the best markets. If you want me to give you a tip, Northern New Jersey. Please note, not coastal New Jersey. Coastal New Jersey is one of the worst markets in the nation. Northern New Jersey could be one of the best. Here's a tip for you.
Around Fort Lee or Bergen County?
Oh, separate discussion, you know. Google Northern New Jersey, it actually comes up with a map on the internet. All right, so here's multifamily market cycle for IRR. The last one I think was CoStar, right? Yeah, the ugly one is CoStar. The nice looking one is IRR, which is Integra. So let me explain this. This is very counterintuitive, so let me explain it to you, all right? So think of this as innings in baseball. 1, 2, 3, don't touch. 4, 5, 6, pretty awesome. 6, 7, 9, very risky. Does that make sense? Most of the time, people want to play here. They don't actually want to play here because it's riskier. Because here, it can stop easily, right? So we want it. Dave Lindahl says, let a market catch momentum before you go in. Don't go in at the bottom. He always tells you the Lindahl cycle does not start at the bottom. It starts somewhere here. So all of these are good. There's tons of great markets here. There's a few here that, notice hypersupply is only Atlanta and Raleigh. These are the two markets that are in hypersupply. This market here is impacted. It will see very, very significant rent declines, right? Now, here's a trivia question. Why was Washington the first market in the United States to start building after the recession? Because the federal government started spending trillions of dollars that they didn't have. When the federal government spends more money, guess where they spend it first? They spend it on their own city. So Washington's had incredible amounts of apartment development. Under no condition go here. It also will affect Baltimore because it's close enough for it to be affected. This market, I still like Atlanta. Some pockets of Atlanta are still good. So Atlanta is a very sub-market based market. What that means is anything close to downtown is hypersupply. Anything further away is expansion. So keep that in mind. That's also true of some parts of Houston, but Houston is more in this area than here. I'm not sure why Houston is not here. In my list, Houston has moved. So it no longer is in this dot, it is in this dot. So we've started seeing that in the last month. And also keep in mind, oil at $25 or $30 a barrel does Houston no good. Okay. True, but I think that the rent declines would probably be 1 or 2%. I don't foresee a recession for the city of Houston. It's a great city. If I had a 10-year outlook and I had that kind of money, I'd invest it in Houston. It's a great market. But in the short term, I think it might see rent declines, small ones. It's not going to see rent increases.
What do you think about Memphis, Tennessee?
I don't know anything about it, so look for it in the graph. So what I would say is this is higher risk and higher rewards markets. The only higher risk and higher reward market in California happens to be Sacramento. Not my favorite market, but there's a lot of people in the room looking right there. So better than Stockton. So if you like California, I'd say Sacramento is not a terrible bet. In my opinion, it would not be in my list of top 10 cities to invest in nationwide, but I generally dislike California, so I have a bias against it. I love living in California. No, there's a whole bunch of Californians in the room. I love California. I just don't like to invest at this point in the cycle. So you start seeing a lot of Californian cities in here. So you see Oakland. Where's San Francisco? San Francisco, San Jose. So know which inning your city is in. We live in an area that's got to be in 7th or 8th inning.
The previous slide said the East Bay it indicated it was on the left, which seemed to be the best quadrant.
So the answer is the East Bay, yes. So again, this is a micro market thing. I would say all portions of East Bay except Oakland are still in a good quadrant. So now except maybe Danville. Those areas are also very inflated. But there are a lot of areas of East Bay that still have some juice left.